Receivables Management Credit Policy. A credit policy is a set of guidelines that sets credit and payment terms for the customer and establishes a clear course of action for late payment. So, credit policy is a clear course of action for the late payment from the customers or debtors or accounts receivable. So, approaches to evaluation of credit policies. There are basically two methods of evaluating the credit policies to be adopted by the company: total approach and incremental approach. The format for the two approaches are given as under. So this is total approach, present policy and proposed policy 1, proposed policy 2. So in this format, credit sales. From credit sales, we have to deduct the total cost other than bad debts. Total cost including variable cost and fixed cost. And we have to deduct the bad debts, cash discount if any. Finally, we will get expected net profit before tax. If tax is there, we have to deduct the tax as well. So expected profit after tax. Now, opportunity cost of investment in receivables locked up in collection period. So opportunity cost, the required return on additional investment made in the receivables. So after deducting the opportunity cost, we'll get the net benefit. So advice: the policy, whatever the policy may be, whether present policy or proposed policy or whatever policy, should be adopted since the net benefits under this policy are higher as compared to the other policies. So whichever has net benefits higher, that policy should be adopted. So calculation of fixed cost, average cost per unit minus variable cost into number of units sold on credit under present policy. Next one, opportunity cost, total cost of sales. Total cost of sales into collection period. So, and required rate of return, so that we will get the opportunity cost. Okay, let us go with the calculations. Illustration: a trader whose current sales are in region of 6 lakhs per annum. So current sales are 6 lakhs per annum. Average collection period is 30 days. That is the present status. Wants to pursue a more liberal policy to improve sales. A study made by the management consultant reveals the following information. So these consultants proposed 4 policies: A, B, C, D. So if trader wants to take A, the collection period will be 10 days more than this 30 days. It means 40 days is the collection period for the policy A. 30 plus 20, 50 days for B. 30 plus 30, 60 days for C. 30 plus 45, 75 days for D. So increase in sales. So current sales are 6 lakhs. If policy A, that is 6 lakh 30,000. For policy B, 6 lakh 48. For policy C, 6 lakh 75,000. Policy D, 6 lakh 90,000. Present default anticipated means bad debts: 1.5 for A, 2 for B, 3 for C, 4% of bad debts for credit policy D. The selling price per unit is 3 rupees. average cost per unit 2.25, variable cost per unit 2 rupees. So average cost per unit is 2.25. Variable cost is 2 rupees. Selling price is 3. The current bad debts losses is 1%. So for the current policy, bad debts percentage is 1. For the proposed policies, bad debt percentage are these. Required return on additional investment is 20%. So this is useful while calculating the opportunity cost. So assume 360 days in a year. Analyze which of the above policies would you recommend for adoption. So solution. So we're going to do this by applying total approach. This is the pro forma and present policy 30 days. 30 days collection period it has. Proposed policy A 10 days more than the current means 40 days. Proposed policy B 50 days. Policy C 60 days. Policy D 75 days. Now credit sales. Here current sales are 6 lakhs. 6 lakhs. So total cost other than bad debts, variable cost and fixed cost, we have to calculate it. So variable cost is 2 rupees per unit, right? So how many units are there? 6 lakhs sales. Selling price 3 rupees. 6 lakhs by 3 rupees means 2 lakhs. 2 lakhs units we have. 2 lakhs into 2 rupees. Variable cost is 4 lakhs, right? So how about fixed cost? See, average cost per unit minus variable cost per unit into number of units sold. Let us substitute with the values. Average cost per unit 2.25, variable cost 2. 2.25 minus 2 into unit number of units sold 2 lakh units, right? Six lakhs by selling price 3 rupees, 2 lakhs, 2 lakhs units. Okay, so it comes around 50,000. Fixed cost is 50,000. So bad debts percentage is 1% on sales. So 1% on 6 lakhs, 6,000 will be the bad debts. So expected profit. So 6 lakhs minus 4 lakh 56,000. 1 lakh 44,000. So opportunity cost of investments in receivables. So opportunity cost. Present policy. Total cost of credit sales. Total cost of credit sales is 4 lakh 50,000. We should not include bad debts. So 4 lakh 50,000 into collection period, 30 days collection period by 360 days. By 360 days into required rate of return 20%. 20%. So how much it will be? It comes around 7,500. Okay, 7,500. So 1,44,000 minus 7,500. 1,36,500. Okay. Now policy A. Policy A. Credit sales. Sales increase in sales will be 30,000 if trader adopts policy. It means 6 lakhs plus 30,000. 6 lakhs 30,000. Okay. Let us calculate the sales for other policies as well. 6 lakhs 48,000 plus 6 lakhs 75,000. 6 lakhs 90,000. Okay. Okay. Now fixed cost, no need to worry about it. We already calculated because it is fixed in nature. So coming to the variable cost per unit is 2 rupees, right? So per unit is 2 rupees. I'll just mention here that sales by selling price into variable cost per unit. So we have sales okay. So selling price sales by selling price. Sales 6,50,000 by selling price 3 rupees into variable cost unit per unit 2 rupees. So variable cost for policy A is 4,20,000 and for policy B 4,32,000 and for policy C 4,50,000 and for policy D 4,60,000. So we already have fixed cost. So bad debt percentage. So for policy A 1.5 percentage on sales. So 6,30,000 into 1.5 percentage. 9,450 and 12,960 and 20,250 and 27,600. Now expected profit. So we have to deduct the total cost and bad debts from the credit sales. So we'll get expected profit. 1,50,550, 1,53,040, and 1,54,750, 1,52,400. So there is no sign of tax. So now we have to deduct the opportunity cost of investment in receivables. So opportunity cost, present policy we already mentioned. So policy A, total cost of credit sales. See, we have to be very careful. We have to consider only total cost. Means variable cost plus fixed cost. 4,70,000 for policy A into how many days? 40 days collection period. 40 by 360 into 20%. So it comes around 10,444. 10,444. Now policy B. I'm just copying it. No, not to. 4,82,000. 4,82,000 into 50 days. 50 by 360 into 20%. 13,389. Policy C. 5 lakhs. Into 60 days. 60 by 360 into 20%. 16,667. And for policy D, 5,10,000 into 75 days by 360 into 20%. 21,250. 21,250. So we have to deduct the opportunity cost from the expected profit. 1,40,106 and 1,39,651, 1,38,083, 1,31,150. So here policy A net benefits are higher. So that policy A is the proposed policy A should be adopted as its net benefits are higher compared to other policies. Okay, and we can do same thing by using incremental approach as well. So how to evaluate the debtors policies by using incremental approach. So this is the statement showing the evaluation of debtors policy using incremental approach. So incremental credit sales. So present policy which is having 30 days collection period, there is no increment in sales. So it is constant. So if trader wants to take policy A, sales were increased to 30,000 more is given in the problem itself. Okay, and for policy B, increase in sales were increment in the sales is 48,000. 48,000 and 75,000, 90,000. 75,000, 90,000. Increment cost other than bad debts. So variable cost and fixed cost. Variable cost is 4 lakhs and fixed cost is 50,000. Only few calculation I am considering from this table. So that is variable cost and fixed cost. Okay. And bad debts 6,001%. Okay. So coming to variable cost, how much is increased if sales increases to 6,30,000? Means for additional 30,000 units, for additional 30,000 sales, how much is the variable cost? Right. According to the output of the production or according to the sales, variable cost varies. Okay. Coming to the fixed cost, even though there is a change in sales volume, fixed cost will be constant. So there is no fixed cost. But here we have to mention the incremental variable cost. That is 30,000 into 30,000 divided by 3. Sales by selling price into variable cost per unit. 30,000 by 3, 10,000 into 2, 20,000 is the variable cost. Here 48,000 by 3 into 2, 32,000. 75,000 divided by 3 into 2, 50,000. 90,000 by 3. See, 3 is the selling price. 90,000 by 3 into 2. 60,000. Okay. So there is no fixed cost. And coming to bad debts. Bad debts percentage is given in table itself, 1.5 percentage. So here total credit sales are 6,30,000 for the proposed policy A. So in this 6,30,000, so how much is the bad debt percentage? 1.5 percentage into 1.5% comes around 9,450. But how much is increased when compared to present policy? 3,450 increased, right? See, if you want the clarity, you can see from this table. For 6 lakhs credit sales, bad debts were 6,000, 1%. So for 6,30,000, bad debts were 9,450. Okay, but how much is increased? 3,450. We have to consider only incremental bad debts. Even here also, 12,960 minus 6 lakh, sorry, 6,000. So 6,960. So here 6,960. And here 20,250 minus 6,000. 14,250. 14,250. And here 27,600 minus 6,000. 21,600. 21,600. Now expected profit. So sales minus cost. 30,000 minus 23,450. 6,550. And 9,040. 10,750. And 8,400. Now we have to calculate the required return on incremental investments. So cost of credit sales. Cost of credit sales 4,50,000. 4,50,000. And for proposal A, 4,70,000. And for proposal B, 4,32,000. And 5,10,000 for proposal, sorry, policy D. So collection period 30 days, 40 days, 50 days, 60 days, and 75 days. Investment in receivable. A into B. So 4,50,000 into 30 by 360. 37,500. Okay, anyhow, I'll mention clearly cost of credit sales into collection period by 360. Now it gives some clarity. Okay, cost of credit sales. Cost, not the credit sales, cost. Cost of credit sales 4,70,000 into 40 by 360, 52,222, and 4,32,000 into 50 by 360. Sorry, it is not 32, it is 82. 66,944. $83,333. 1,00,000, sorry, 1,06,250. Here, please don't get confusion. We are considering cost of credit sales. Means total cost of credit sales, not just incremental cost. Total cost of credit sales means is the combination of variable cost plus fixed cost. Variable cost for proposal A is 4,20,000 and fixed cost is 50,000. That is why it is 4,70,000. Here also 4,32,000 plus 50,000, 4,82,000. 4,50,000 plus 50,000, 5 lakhs. 4,60,000 plus 50,000, 5,10,000. We are considering cost of credit sales. It means total cost. Okay. Because we are calculating the required return. Okay. So incremental investment in receivables. So incremental investment in receivables. How much is the present policy? There is no such thing. But here, how much is increased? 14,722. That is 52,222 minus 37,500. Now 66,944 minus 37,500. 29,444. And 83,333 minus 37,500. 45,833. This is incremental investment in receivables. Okay. Now, required rate of return. How much? 20%. So, required return on incremental investment. This is the incremental investment. So, required return, how much? 14,722 into 20%. 2,944, 5,889, 9,167, 13,750. So finally, net benefits, expected profit minus opportunity cost. Net benefits are 3,306, 3,151, 1,583 minus 5,350, because opportunity cost is more than the expected profit. Okay. See, instead of calculating this, we can simply mention the incremental opportunity cost. So how much is increased when compared to the present policy? So here in this case, 2,944, 2,500. The difference between 10,444 and 7,500, that is 2,944. Same amount, here it is. And here also 13,389 minus 7,500. The same amount. Okay. So in this case also, policy A has highest net benefits. So the proposed policy A should be adopted since the net benefits under this policy are higher than those under the other policies. So there is another method of solving the problem is by computing the expected rate of return. Okay. So we calculated through total approach and incremental approach. And there is another method called expected rate of return. So by using this formula, incremental expected profit by incremental investment in receivables into 100, you can simply calculate the expected rate of return. Present policy. So for present policy, incremental expected profit there is no such thing for the present policy. For policy A, incremental expected profit $6,550. $6,550 by incremental investment in receivables. Incremental investment in receivables 14,722 into 100 comes around 44.49%. Policy B, incremental expected profit 9,040. 9,040 by incremental investment 29,344. 29,444 into 100. 30.70%. policy C. $10,750 by 45,833 into 100, 23.45%. Coming to the proposed policy D, $8,400 by incremental investment in receivables 68,750 into 100, 12.22%. See here also, policy A has highest expected rate of return. It means proposed policy A should be adopted. This is how we have to calculate, we have to evaluate the credit policy.